topic, of course, that we spend a lot of our world here at DLP in. So before we dive into that, let's go to the first slide here, Kyle. I want to share some live updates here. We've won some cool awards since last time we all chatted here. So we won 2 awards called the Stevie Awards through the American Business Association. Won Entrepreneur of the Year for the segment of real estate. And then we were a Silver Award winner for what they call Achievement in Growth. So that was pretty cool. And a lot of hard work, of course, went into winning those awards here. So proud of that. But like I said a moment ago, I'm going to be here chatting largely with today. You're going to hear mainly from Melanie. And you can see there, if you read through the screen, there's quite a background there. And Melanie's only been in the business, what, 5 or 6 years?
Absolutely.
Just a very, very short amount of time, but it's had a pretty amazing background. I think that that resume is, per se, the bio is a bit modest, and that's generally how you'll come to know Melanie. For those of you who've been able to spend any time with her, she's run property management organizations, 5, 6, 8, 10 times the size of DLP. Been on the front lines of leading those organizations, driving operational execution. And we are very honored and pleased to have had Melanie join us early last year and take reins of leading our property management team, which is today about 160 team members. I think by the end of June, we'll be over 200 team members. And so Melanie, welcome.
Well, thank you.
So I know you got this great overview on here, but tell us a little bit more maybe that we don't see on the screen about yourself and your background here in multifamily.
Okay, well, first I will tell you that I have been married to my husband, Jim, retired Coast Guard, and we've been married for 33 years now and have 4 wonderful daughters. And that is probably one of the reasons that I am so focused on the fact that we offer multifamily for families. And we cover everything from housing, from when somebody's in college to when they go on, have their own families, and then even as they get into those more active years. And that's one of the things I love about this business. Having done everything from construction to new development to lease up to subsidized housing, this is just a passion for me, offering housing and caring about others.
Awesome. Thank you. So go to the next slide here, Kyle. So before I turn the floor fully over to the question, Melanie here on a few things, what's going on. I'll give you a couple of government updates and Melanie can chime in here on as well. Go to the next slide for me, Kyle. So first, World in North Carolina, which we're highlighting this first, not because I'm heading to North Carolina tomorrow at 5 a.m., but because that's where our next event is. So our next event, our real estate mastermind weekend event we do for top operators, and then our real estate roundtable we're going to be doing for all of you guys, where we're going to give you exposure to talking to some other great operators, in addition to Melanie, on June 18th, which we'll highlight at the end here. North Carolina starting to reopen. Phase 2, where they reopen the restaurants and most businesses, starts as of today at 5 p.m. So as we finish up here today, and we'll continue through June. So lifting the stay-at-home orders. So it's pretty exciting. Florida here, where we're all talking to you from right now, has been open, for the past now 2 weeks. And I know they say at 50% capacity, but one of the things. Sorry, 1 second. A little audio issue here. There we go. So one of the things that I saw was interesting when all of a sudden I noticed here how quickly everybody came out to the restaurants here and how packed everything has been. I said, wow, it doesn't look like that restaurant's only at 50%, but it's actually 50% of the marshals, fire marshals code limit, which most restaurants never are that full. So it's been amazing to see how fast people, those of you who aren't in places that have opened up, see how fast the world has opened up here and how anxious people have been to get back to work. Our office, almost, I think everybody but one employee who's got some childcare challenges has chosen to come back in the office. We've been alive and well. It's been really awesome. Pennsylvania, some really exciting news. Real estate is now essential. As of yesterday, real estate is essential. We can get back to showing houses, selling houses under some, of course, the new normal of wearing masks and social distancing and so forth. So that's been pretty exciting as well. So the world's opening up, and it's been amazing here at DLP. So some of the questions that we get a lot about, what's happening with rent collection, what's happening with people still leasing homes, or people buying homes, or what are we seeing? today I get to not have to be on the hot seat as much. So I'm going to get to ask you some of these questions, Melanie, and get your perspective. So let's go to the first question here, Kyle. So are people paying their rent? I think that's the number one question I've had every single day for the last 2 months. So tell us how we're doing with collecting rent.
Oh, they absolutely are. We've been very fortunate. In fact, we had anticipated in the rental housing that the pandemic would create problems in rent collection for several months. And it really hasn't. We've seen more collection in May. We're still about a point and a half ahead of where we were last year. We've already collected 93% of our revenue for the month of May. And that's about 4% higher than what NMHC is showing for the industry as a whole. So that's been very good. And I think a lot of that, what we've seen with our residents is that because we took care of them, they paid their rent when they were able to get the stimulus, when their jobs came back. And of course, we also took care of them. And when they needed payment plans, we were able to do that.
That's awesome. And to give another perspective, so we're doing better than we did last May in a non-COVID environment. And then we're doing significantly better than we did. You guys all heard, anybody who's been tuning in, how we ended up April, collecting about 94.5% of our rent, a little bit off our March, but still, all things considered, we thought pretty well. And when I went and told, the bankers and the financial experts in the world, everybody's response was, oh, well, in May is when it's going to get bad. All right. The negative people out there said, oh, April's going to be really bad. And then when April turned out to be, I think for everybody in workforce housing, turned out to be pretty good. I was like, oh, well, that's because you haven't dealt with May. That's when people aren't going to pay. And we're about 7% higher than we were in April, the same time in the month. So not that, of course, we're going to end up 7% higher than a month. It's not possible unless you're going to get me more than 100% of the rent.
We're working on it.
But considerably better than last month. So that's it's been really, really amazing. And shout out to Melanie and the whole team, because they put in probably 3 times the amount of work for rent collections as in a normal month. But the results are coming. And like I said, these communities that we run, I don't think we talk enough about them. These are communities where our people work on site, our employees work on site, some cases live on site. They build friendships and relationships with the residents. They've been there every day with the residents, solving their issues, going in and doing service work, leasing apartments, answering issues through all of this. And that's paying dividends. That's awesome.
Yeah. And as you know, we've had our highest occupancy ever as well.
So Kyle, go to that next slide. That's going to let Melanie talk a little bit about that. So yeah, highest occupancy ever. So, oops, I thought I had that in the next slide. So maybe it's the
already.
There it is. Highest occupancy ever. So pretty amazing.
Yeah. And we're excited about that. But if you go to the next slide, I can tell you a little bit about why that has occurred. I think that one of the questions, Don, you've asked is, what are we doing differently or better than other housing providers and to ensure rent is paid? Well, the reality is it starts with our people at the communities. That's where it starts every day, because we not only have put even more focus on ensuring that our residents have what they need during the day. Think about it, Don. You have these communities in single family as well. Well, suddenly we find ourselves with all of the residents home 24/7. That has never happened before. And communities aren't typically built to accommodate that. And so we really had to rethink it. One of the things that we did differently, we never closed our offices. Our community teams continued to work. They took safety precautions. They took care of the residents. We even started our marketing and revenue acceleration team, even started a DLP on-demand video. We knew that parents would need things for their children to do. So every day, these teams they built videos, everything from coloring Easter eggs to having quarantini martinis. I learned more about martinis on Fridays than anything. But we really made it fun, and the residents appreciated that. From really taking care of them, even putting happy goodies on their door. We offered curbside service for those that did not want anyone in their home. And that meant that they would call, say they needed a light bulb, say they needed something, and we would run it out to their car. We still did virtual tours. Our team members did not stop. They were out there every day, and they deserve the credit.
That's a good point. It's why we're at our highest occupancy ever. So we've had tremendous leasing activity, tremendous number of move-ins, but almost nobody wants to leave.
That is correct. And in fact, we have renewed 244 residents in the month of May.
Wow.
In 21 days, we've renewed 244 residents. And that's not simply because people didn't want to move. It was because our teams were going out there and talking to them. And we're seeing longer term leases. We're able to secure 15-month, 24-month leases, which is changing the industry and guaranteeing our revenue for the next 24 months.
Awesome. Kyle, go ahead and move to the next slide for me here. So next question here from Melanie. So say the second wave, of course, some of the, I don't know if you want to call them experts, but the people who want to kind of create anxiety and stress here, there's a lot of talk this is going to come again when it gets cold again. We're going to see a second round of this, and so how do you feel? If we see this again come in November, December, October, there could be some political reasons why there's a big push here to another state shutdown, government shutdowns, increased unemployment again, all the same things we all just have been coming out of. How do you see that affecting our properties? And I'll focus it on our property side. How do you see it affecting us if we had to go through this round again?
I can confidently say I don't really see it affecting us negatively at all. And I say that, now I'm not going into the political side though, Don, but I can say it won't affect us because think about it. We go through hurricanes every year. We go through major storms, major flooding. In multifamily, every community, if you have 350 homes, then you have 1,200 residents at least. So we go through that same dynamic. We've already done the hard part. We've already lived through the first part of this pandemic when people were afraid. They didn't know what to expect. The government shut down, the city shut down, their work shut down. The hardest part is over. From here, we've already proven to our residents that we're there for them, and we will continue business as always.
Awesome. Excellent. Kyle, next slide for me, please. So our investment of choice here, is multifamily housing, but I like to think of it more workforce. So we have single family, we have, townhome, we have multifamily. You can see on the picture there, kind of more traditional type multifamily. So it's been a trend here for a lot of years now. Rentership's been on the rise. Right. Any feedback on why you think that's the case, that more and more people are choosing rentership, and how do you think this next cycle, whatever it exactly looks like coming out of COVID, how that'll potentially change or not change?
Well, I think it's no secret that renters by choice, that number is growing in the United States. And the homes for sale, it gets a little tighter to buy homes, but that's not why. There's room for both, absolutely. But when you have young people right now, they're focusing on where they want to spend that disposable income. And oftentimes you'll find that is renting initially. It allows them more freedom to travel. It allows them more freedom with their jobs to be able to move with their jobs. And then they save up. So instead of maybe buying that small starter home in some of these communities where you would see that, we now see them saving up and buying a much larger, more expensive home. Then we have other communities such as Wexford, where we bought, in West Virginia, great community. And there you will see more home buyers because of the market there. So rentership is on the rise. I think it also is because people realize now that they can get service levels that are unparalleled when they rent. They get the amenities, they get the fitness centers, they get everything and a sense of community.
Awesome. And I know we've talked about this in previous sessions, but one of the things that's most interesting, Wexford's a good property that has this dynamic is the biggest growth sector of rentership is actually the baby boomer generation, yes, the older generation going from home ownership to rentership, which is kind of abnormal for the last couple hundred years. That's become kind of a new normal that we're seeing more and more. So we focus heavily, though some of our communities, again, the Wexford we chose, you could would say is an A community, or at least an A minus community. I try to think a lot less in how I describe what we invest in than Class C or Class B, Class A, than it's workforce. It's housing for the people, what people can afford in that local area, affordable for where the incomes are. But a lot of people categorize what we invest in mostly as Class B or again workforce housing. So how do you see what if we head into a recession environment like some are predicting here that we're bound to do? How do you feel this asset class of workforce affordable housing is going to do? And do you expect to see any challenges? I know your past life before joining us, you moved heavily into the Class A space, very often the most expensive kind of community in the market. So how do you kind of see the industry as a whole and the different asset classes doing through this potential recessionary environment where unemployment levels stay high?
Well, I do believe that when unemployment levels stay high, you will see individuals and families revert back more to that workforce housing. There's just a comfort in feeling like you're not spending your entire paycheck on where you live. So so what we see with, even like you talked about with the baby boomers, people choose not to put all of their wealth in something, in a home, just for show at that point. It becomes more of necessity. It becomes somewhere they feel comfortable, and it becomes where they make a home for their family. So workforce housing, for me personally, I find it very gratifying, because we not only are touching the resident and the leaseholder, but we're touching the families. And when you talk about folks that are pretty much in my age bracket at this point, you're seeing folks that are 50 years old that are selling their homes, that are going into rental housing, which is terrific for the rental market. And the reason that is they want to spend that money traveling. They want to take care of other things. They don't want the yard work. They don't want to have to worry about how much they're going to have to pay when their dishwasher breaks down. So as the market continues, as unemployment stays high, and as we know, we've seen record numbers falling unemployment every single week, but it's not going to really affect what we do. You will see more of that what people call the A class, and some of the urban housing. They're anticipating it taking a bit of a vacancy hike. And part of that is because people will move in together, and you will see more people move to suburbs.
Yeah, that's a great point. One of the things, the best ways to think about this is, I see a lot of times in, ground up Class A communities, in terms of the screening criteria that they require in terms of the amount of income somebody has to qualify. I've seen many of these communities where they justify, 40%. So meaning, 40% of your gross income, not your net income, goes to rent is how they qualify you. And my belief is if 40% of your gross revenue, that means more than one out of two paychecks you get a month of your net paycheck is going to go just to your rent. It doesn't leave enough money to live comfortably. And so what we focus on when we buy a community is going into a market where our average rent is going to be around 20% or less than the average income in that market. It doesn't mean always our residents are at 20%, meaning based on what the average incomes are, they're 5 times what our rents are, which means there's going to be a high percentage of those people in that market who can afford our apartments. And it's a big difference. It might sound subtle, but it's a really big difference in having a strong demand in any market for people who can afford to live in our apartments. Awesome. So let's go to the next slide here, Kyle. So this just walks through our process. I'm not going to spend a lot of time on this, but Melanie could touch on, Melanie gets involved in her world, and we have an investment team here who's mainly housed out of this office here, who's bringing these hundreds of deals every month, and then they're putting them through initial levels of due diligence, including many times calling on Melanie's team members, say, hey, can you go out and walk this property, or hey, can you give me perspective on this community, or what do you know about it, and going to our local experts there. But then once we get down to we narrow down to the 10 or 30 deals a month that we're really looking to buy, of going through our filters, that's when we're getting out there and evaluating them at a heavy level. That's when we're engaging Melanie and our directors and our VPs and our service teams and our construction teams. And anything you want to share on, kind of what you've learned in going through and evaluating investment opportunities And, perspective on our funnel here, as you've seen here, Melanie, on this past year, of all these hundreds of deals that we get involved in, the very small number at the end of the day that we get through the process, and we end up buying after we get everybody's feedback and opinion, and everybody screen it and poke holes in each investment opportunity.
Well, I think the fact that we actually take such a very deliberate approach to looking at all of those deals is one of the critical reasons for our success. And with that, what our investors can rest assured is that we're not going out simply to buy other deals. We're not simply trying to close a fund and buy. We're actually looking for deals and for assets that are long-term holds for us, that we know are going to perform. They're going to be in markets where we know they will hold up. And that's one of the things we look at. We do work very closely with the investment team. And with that, it's not just about the numbers. It's also about really intimately learning about the market that community's in. It's about learning what the household income is. Who are the residents moving into that geographic area? Who are the major employers? What is anticipated to happen with the employment over the next 3 years? We look at all of that, and then we take it a step further. And as we get down as to what you said, Don, about really doing that deep due diligence, we do something that other owners don't. We walk 100% of the homes, of those apartment homes. We walk 100% every time. And that really allows you to know, what are you going to need to put into that investment to get it to that level you want? And it also allows us to be certain that we're not over improving an asset, because that can be critical as well. We have a certain target market that we want to be able to increase the rents. So we're not going to go in and make improvements that would require us to increase $500 a month, like where I may have been before, versus here where we look at it and say, okay, our resident base can comfortably stay within that 20-25% of their income, and we can increase the rate $150, but not just to increase it. We're increasing it so that we can give them value, so that we can help them make it a home that they will be proud of, proud to bring their families, proud to bring the people they work with.
Awesome. Thank you. Great feedback. Let's go to the next slide there, Kyle. So let's talk a little bit about the real estate management. So we call our world, that some people call property management, we call it real estate management because there's a few different components to it. So first, tell us a little bit about your team here that you count on to drive results, and then we'll talk through the different components, the three kind of legs of the chair for real estate management.
Mm-hmm. Well, I'm really blessed. We have a very strong team. And with that team, when you look at the real estate management professionals that make up our property management group, we have more than 180 years of experience in our chosen fields. That is huge, and it pays off for our investors. So when we look at it, really, we have some very key departments that you spoke about, Don, and I'll go through theirs. I look at it as the three legs of a stool. And with each of those, each one works together to make a very strong foundation. And that is part of the key. And then we add a fourth one on top of that. We're on top of the forma. They're our check and balance. So let's talk about some of these teams individually then.
Sure. Go to the next slide. This is a team mainly in property operations.
Correct.
This is our team largely in construction management.
And construction and redevelopment is a part of that third leg of the stool as well. And that is where the construction team are the ones that really make our communities look great. They oversee the improvements. They oversee the large scale projects. So anything from whether we just decide to reseal and stripe, or we build a new playground where there wasn't one, or we go and we have to replace wood, or better yet, we go in and we renovate 100% of the homes at a community, and we add touches to it that the residents love. It's this group of professionals that do that for us.
One thing I want to highlight on this group of professionals. So Rick Montgomery is a new face you'll see
Yes.
here. Rick is on week 2. And so we talked about in some of the previous sessions here that this is going to be an amazing opportunity for DLP to grow and acquire. And Rick's a great example of that, as he's been in similar roles at organizations 3, 4, 5 times DLP size, leading construction and service for those communities. So we're really excited to have Rick aboard, just relocating here to St. Augustine, although we have him out in South Bend, Indiana right now.
That's what I was going to say. He's out in South Bend, week 2, actually day 6, 7.
Yeah.
He is out in South Bend looking at a project there with Frank. And that's one with over $1 million in renovations going on and work. And so we're really excited about that. Rick has been a great addition, and he oversees our service quality in addition to our redevelopment. And then Frank Sinatra also oversees work on that redevelopment team. And then we've got Larry Greenberg, heads up our Northeast on the construction. And you'll see him very involved on development and some of the new builds we're doing.
Awesome. I'll go to the next slide there, Kyle. There we go. This shows you here the map where our communities are located. You can see South Bend at the very top. That's our most northern community. 739 happens to be 739 homes happens to be our largest. Next slide. Go to Kyle, next slide.
You can see we focus on that coastal side as well. So this is a photo of Shana Whitehead. So we talked about those 3 legs of the stool, and Shana oversees the property management operations, which is essentially the day-to-day operations of taking care of those residents, of collecting the rent, which is an important piece, as well as ensuring that our teams are top-notch and they're involved in everything that goes on in those communities. Shana came to us after having a great deal of multifamily experience in several different large companies, including REITs, as well as having run a very large portfolio of single-family homes. So we're excited to have Shana leading our property management operations.
Awesome. Next slide. We'll move here a little quick here through the team members here. Shana's on, she's a veteran now compared to Rick. She's on week 5 and talented.
And Amy actually runs what I call that 3rd leg of the stool, but a very critical piece of it is revenue acceleration. And what does that mean? Well, that has to do with everything from curb appeal, running our DLP on demand, and to revenue increases. So Amy goes in on every due diligence, and she will study that market, become intimately involved, not just with the competitors, but with every unit and floor plan. She helps us determine the rate increases, helps us to really find what is going to drive revenue. She's one of the reasons we've had 244 renewals in the loan.
Awesome. Awesome. Next up, Mary.
Yep. Mary leads our asset management operations and is the one that keeps us on track, essentially. Mary starts off working with that investment team in building the business plan and in helping to communicate the business plan, helping us build out the budgets, and then also leading the reporting and the trends, and helps us really stay on top of it. So by these groups working together, reasons that we've had well more than 1,000 new applications in just the last few months.
Sorry about that, everyone. It looks like we're maybe having some audio issues, not hearing Don.
All right, so Wi-Fi is back on now. My cell phone gave out, so you guys should hear me now, and I'm back on Wi-Fi. We'll back upload it here. So sorry, we had some audio issues there, but we were saying our people and some of the innovative practice we do is really what separates us. So let's move to the next slide here, Kyle. So this is a statement here from you, Melanie. So tell us a little about this.
Well, I think that we operate differently because we really focus on an elite execution system. And that ensures that we set goals. That ensures that we monitor those goals every single day in our commitments. But in the end, it comes down to three simple things. We manage the business, we lead the people, and we drive sales and revenue. That is one of the differentiators that makes us strong.
Awesome. I love it. Next slide. So, yes, so we kind of covered this one already here. So yeah, we bring the whole team in. So we're looking at a deal right now that we're finalizing going to due diligence, and we'll bring the investment teams. We'll bring at least the lead analyst. We'll bring our senior director of investments. We'll bring myself. We'll bring the construction team. We'll bring the local, whoever our lead director or VP in the area is. Melanie's typically out there. One of our construction managers. We'll bring outside contractors involved. We'll bring third-party appraisers and engineers, and we'll have a team of 12, 15 people out on a due diligence trip and do, as you said, walk through every unit and develop a full detailed plan. So that's a big differentiation that we have in that approach.
And Don, we go through every lease. We look at what the resident household income is for every resident. We really study not just the last 12 months, but even more. And I think that is a piece that our investors can rest assured on, is that we're out there looking at it because we want to get it right the first time. But it really is about the execution, and it's about excellence. It's about surpassing those expectations and not settling for just being adequate as some of our competitors do.
Awesome. Next slide for me, Kyle. So we kind of hit on this already, so let's continue here forward, Kyle. Go ahead and continue forward. I'm looking at the time here. I want to make sure we get to questions here. So I'm going to guess we're going to have some questions for Melanie. I know this is something you focus heavily on. Tell us your little statement that I get to hear. Melanie's office is right next to mine, so I get to hear her talking about this quite often.
Well, it really is about offering a wow experience for everybody. It's not about customer service. It's about the overall experience, where every single interaction, from waving at one of our residents in the middle of the day to calling them by name to making it an experience that they can remember, we make magic. And that's what our team does. It really is creating a magical experience, whether we're unplugging a toilet, whether we're painting an apartment home, and yes, those things do happen every day, whether it's on Thanksgiving Day or Christmas Eve, that somebody has a concern in their home, our teams are out there. It's about service first and foremost. We go the extra mile, and our residents appreciate it.
Awesome. Thank you. Making magic happen. I hear
Yes,
at least 10 times a day here. And so do our teams, and they think it because it's in their heads. They hear it all the time. It's part of their day-to-day.
They're terrific.
System. Yes. All right. So a reminder here. So one of the cool things here today is this was a little bit of a small taste to what we're planning here on June 18th. So this event we did here today, this 4:00 webinar, we're continuing this forward here. But June 18th, about 4 weeks from now, is going to be a little bit different, as we're going to be doing this live. Our plan is to be doing this live from Asheville, North Carolina. We're going to have a bunch of top real estate operators, groups that we lend to, we partner with, some of our internal top operators, such as Melanie. We're going to have a roundtable discussion where our plan, and hopefully the state of North Carolina works with us on this, and nothing changes, but we're going to be able to have live investors, some of you dialing in with us right now in the Asheville area, or those who want to travel in and spend some time with us, we'll be able to be in the audience with us here, be in the room with us, chatting and asking, not just me and not just Melanie, but asking the people we lend to for their perspective. We're going to dive into different investment strategies that are available today, get perspectives from operators of all different sizes and experience and geographic locations to how they see the outlook on the market, the economy, how they're adapting, how they're finding opportunities. And then all of you who are not going to be able to join us live will be able to join us via Zoom here and social media and ask live questions as well to our top operators in an open format. So we're really excited about that. So please go to our website and RSVP. And one of the reasons we're going to have these top operators, no offense to all of you, but all these top operators aren't coming just to Asheville for us to get a chance to chat with them in this forum. They're actually coming in because these are operators who really want to grow amazing businesses and are coming to learn and share and mastermind for a whole weekend. This is something we've done. This is our second one in Asheville. I think it's our 5th overall event like this. And we spend a whole weekend together. I lead these events, jam-packed days of education, training, and then evenings and early mornings packed of building relationships and getting to know each other. And so we're really excited. Again, hopefully the state of North Carolina continues to work with us. And we, as of now, have over 30 top real estate operators coming to join us. We expect to end up having well over 40 joining us for the weekend. These are the type of people we lend to. These are the people who we're taking our capital and our funds, we're deploying that capital out to them. That's this group of investors coming are the group of investors that we can please to say, again, all of them paid their interest payments for the month of May again, which is pretty awesome. So we work with really high caliber operators thriving in this environment. And then hopefully again, live, we certainly will be live from Bethlehem, but hopefully we'll be able to have hundreds of you with us at our investor dinner, July 17th. This is our normal quarterly big event we do in Pennsylvania. So our plan, we have the Arts Quest, for those of you familiar, reserved. And we're waiting to see what how many Pennsylvania restricts us to. So please pay attention to your inbox and your mailbox and RSVP, because we may be under real limitations to how many people we can let into the room. But then we will stream that live here for those who can't join us face to face as well. So with that said, any additional questions, you can reach out to any of us as we talk about each and every week. And let's dive in here, Larry, Rich, to some questions that people may have for myself or Melanie.
Excellent. So thank you very much. Just a reminder, you can go ahead and put those questions inside the Q&A or right into the chat. But we do have quite a few questions coming in from email and social media. So the first one we have is from Paul. Says, how do you differentiate between workforce housing and affordable housing? And are any of these apartments Section 8?
Okay, that is an easy question. So yes, what we do is we have workforce housing. We do not have any communities that are what you would classify as your subsidized communities. While there are numerous ones that are terrific in the United States, that's not what we currently do. Now we may have residents there may be a few residents who have to go out, like in the time of COVID, and they have to get help with their rent, and that's fine. Our focus is on offering every resident the same wow experience, the same magical home, and regardless of what their rent payment is.
And what percentage would you say Section 8, for those not familiar, is a form of voucher from a local or state municipality? We work with a number of voucher associations that pay part or all of the rent on behalf of the resident. So what percentage do you think of our residents are on some sort of voucher subsidy right now?
About 3%. It's
it.
a very low number.
Yeah.
Excellent. Thank you very much. And a very associated question, similar along the lines, but from Carol. Are any of these properties in opportunity zones?
Yes, they are. And we have several of our tertiary markets, which are opportunity zones and are continuing to grow. We're seeing some terrific growth in what I would say is the economic forces of it. And even in the ability for those individuals to find employment that is long-term, even during COVID.
Yeah, and to give maybe, Carol, to your question, so absolutely, we have properties in opportunity zones, areas that are designated for investment, where new investments coming into these markets and improving them, which is great. The opportunity zone is the greatest real estate incentive program there's ever been. In order for a property we own to qualify for the benefits to you as an investor of being an opportunity investment where you can defer or ultimately have gains forgiven that you are pulling out of, say, the stock market, we have to do more value add than what we pay. So we bought a community for $5 million. We have to spend more than $5 million on redevelopment. So it's really a incentive program built for new construction in most cases. So we don't currently have any properties that we are able to offer in an opportunity zone type fund where you can take that advantage. We are working on one here actually in St. Augustine right now. It's over 500 homes, rental homes, that's in an opportunity zone that we would set up if this deal gets through all of our due diligence. We would be able to offer this out as an opportunity zone investment and get all those tax benefits. We haven't had one yet, but I certainly expect we will.
Excellent, thank you. And Larry, on your end, I got a few more coming in here, but
For sure. Yeah, I would love to stay on the property front, but more from the fund structure side and the returns. So this question is from Art and also from Steve. So obviously we've never missed a targeted rate of return. We've always exceeded them, never lost a penny of principal for investors. But in regard to if there ever was a time, for instance, if the profits or the return was less than the 10% in the lending fund or the 6% pref in the housing fund, how do you handle that? Do we sell assets to make up the rest, or do we erode the investor capital that way? Can you tell us how we would make sure that we can continue providing those returns based on performance?
Yeah, it's a great question. So if we had a short-term challenge, for whatever the reason is that we missed a preferred return, if it's a short-term challenge such as some effect of a COVID type environment, which certainly we've just come through without missing any preferred returns. But if we did something that causes in the short term to miss a preferred return target, how we structured these funds, each of the funds, is how the pref structure actually works is you have to be caught up for any losses you would ever have, which of course we've also have not had. We'd have to catch an investor up for any accrued preferred return. So if we missed a preferred return, say in the month of May, June, we owe them their June's preferred return plus anything we missed in May. And that continues to accumulate until all investors have been trued up to their preferred return since the day they invested. If we had a fundamental issue with our investments where we were no longer going to be able to hit our returns without selling assets, and as an example, that could be an option to generate returns, but that would be a very large fundamental problem with our investment strategy that certainly we don't expect to deal with. And again, coming through COVID, one of the things I didn't really hit on here today, Larry, is probably worth mentioning. So not only did we come through COVID here, and I'm not gonna say it's all over, but we've come through the hardest point of the world being shut down with hitting all of our return targets to all of our investors, not just the preferreds, but the targets. Actually, in a lot of cases, such as on the property level, we've actually increased our cash flow. But through that whole time frame, we also were able to hold to our ability to be very liquid. So we actually have come through all of COVID, and no investor waited even 60 days for redemption for the very, very, very small number of investors who wanted or needed liquidity for some challenge they were dealing with. So this has been a great example of us being able to test our not only our returns, but our liquidities and our approach through, that's been a pretty challenging time for most.
Great. So I've got another question here from Jim. As an investor, what property level information is available to me to do my own diligence and assess my investment in your funds?
Yeah, so if you go to our website, you can get right there on the top and click the investor login button, or go to dlpcrowd.com. And literally you can do it in a couple seconds, or you can ask Larry or Rich or Bob or Mike to do it for you. We'll set you up with a login. And in that login, you'll be able to see, and we just, example, on the housing fund, we just finished here recently uploading every single investment summary of every community we own, which we own over 4,000 apartments in the housing fund. You can go in and see the pictures, the status of that property when we bought it, all of our underwriting assumptions, our value add strategy, how we structured the deal. You can go through that on every one of our investments. In addition, you can go in there on each of our funds and you can see all of our existing assets, see all the loans we have outstanding. You can see our past loan tapes. You can see our balance sheets, our income statements. You can see all the audits by our third-party auditors. So all of that information is available to you, and then as well as past presentations and overview. And then if that's not enough, and you have even more specific questions you'd like, we have whole realms of what would take up this entire conference room. Fortunately, it's in Dropbox type files, but of even deeper levels of due diligence that groups like pension funds or banks do on us that we can get to as well if there's an even deeper level of information you'd like to see.
Awesome.
Great, thank you.
Here's another question pertaining to the property level and the fund level as far as we value our assets. So how do we value our fund assets, and how often do we recalculate NAV for different investors?
So all the returns that you'll see in all of our funds, everything we talk about, everything we've shown in our returns historically, has always been realized, meaning we're only talking about returns that we've actually earned and distributed to our investors. We're not going in there and we haven't historically said, hey, we generated a 13% last year, and that's based on the fact that we increased the value of our portfolio. Even though across our history, of course, we have been increasing our value of our properties. And that's why, in the past 18 months, we exited communities for 30, 40, 50, 60% annual IRRs. But we didn't show those returns until we actually had sold the property and realized the profits. In our housing fund, being our first ever evergreen fund, we had to implement a NAV valuation process, because we had to be able to give a value that investors could come in with the liquidity provisions of the fund. Investors could come out, as some of these assets we're going to own over a long period of time. So we have implemented a process of NAV, which is going through and valuing the underlying assets on a regular basis. But our 12% return targets are our target over the course of the fund of what we actually realize and distribute to our investors. But every year we do have to go through and value our assets. So how we do that is throughout the year, we get third-party appraisals and valuations done on our properties by independent appraisers. And then we take those values that we gather up over the course of the year, and we provide an end-of-year value as of 12/31. What's the value of each of the underlying properties? So then we take those cumulative value of those properties plus our other assets such as cash, and that creates a value of each unit. So every year we go through that process of doing that. And really that valuation process only matters if you're going to exit the fund or you're just joining the fund now. For those staying in the fund for years, which is what most of our equity investors do, it's great when we see the values go up each year, but what we really want you to focus on is what we've actually realized and distributed. And but if you want to decide you want to exit the fund, that's the price you're going to be able to exit out at. So be able to realize that increase in value. If you wanted to add more to your investment, it will be at that updated value. But one of the really unique things, and for some of the investors who've been with us through the transition from the preferred return equity fund to the housing fund, some felt it took a little longer than it should have, and we'll admit that's true. But the number one reason that it took us extra long to get this fund launched is because our attorneys kept telling us that we couldn't do what we insisted on doing, which was we kept insisting that we refused to take a promote to get to earn profits on money that's not realized. So we said, yes, we have to do this NAV valuation. Yes, we have to be able to set what's the increase in the value of the assets, but we're not going to take profits for increasing the value of our properties until the point that we've actually sold those properties and we've realized those profits. And what we were told by one of the largest law firms in the country, so these funds, is nobody does that. Everybody takes profits for increasing the value. That's your right. You're entitled to get profits for increasing value. And we just insisted that we only get paid for realized profits, not for increases of value, paper increases. So that's something we think is a big differentiator of how we structured our fund.
And definitely falls in line with our newest core value of stewardship. Right?
Yes.
Yep.
I think it also ties into the transparency that we have. Just like you spoke about on the investor portal, that kind of transparency is not easily found in businesses today. And I think it is something that our investors do respect.
Agreed.
Melanie, in the interest of full transparency, we have a question here from John. Clearly you and your team have been doing amazing things and lots of successes are being shared, but what's one thing that keeps you up at night regarding our portfolio or your job in particular?
That we haven't doubled in size. That is probably the one thing that keeps me up. I love to grow, and we've got some great leaders in the field. We have wonderful team members, and every one of them are working on that leadership development. So what keeps me up is the growth plan that we want to achieve, along with what else can we do? How can we continue that 20-mile march that we really focus on execution? And how can we continue to be ahead of the market? That's the key.
So So just going back to sort of a little bit on the conversation around transparency, around the valuation, even just what we do differently from other funds, right? You mentioned if there is a preferred not hit, that again, it would be accrued and accumulated. But can you talk a little bit about our position as fund manager, how we subordinate our fees to investors, and then also the audit process on the valuation?
Yeah, absolutely. So yeah, we do a number of things in how we structure our funds to align interest and frankly, not only align interest, but put investors' interest first. So another big one is the preferred returns are paid before our management fees, and which is again very, very different, very unique. If you looked at 100 private funds, maybe you'll be lucky to find one other one that's structured that way. So we want to make sure we get our investors their cash flow first. Another reason why we've never had investors not hit a preferred return is because they're getting the cash flow first. The other big point worth mentioning on the front is, when I don't run the DLP housing fund and say, all right, the assets that aren't as great, I'm going to put in the housing fund, but the really great deals I'm going to keep over here. And those are the ones that I'm going to invest in, my family's going to invest in. We own the properties in with the housing fund. We're by far the largest investor, over 20% of the capital in the housing fund today. In our entire real estate portfolio, about 40% of the interest. So our interests are completely aligned in the performance of the properties and how we structure the investments.
Great. And in terms of the audits that are done on valuation and just on the funds themselves, can you tell us a little bit more about that or tell our investors about it?
Yeah, so the DLP Housing Fund and the Lending Fund are both audited by Cohen Resnick, one of the largest real estate specialized accounting firms in the country, if not the largest. I think they're the 8th largest accounting firm in the country, just in general. Very, very, very thorough. We've historically used a great firm in the Lehigh Valley in the Pennsylvania region called Bucknell Lasecki. They're still helping us do a lot of tax work, and then they're still handling the audit of the Income and Growth Fund. And then we get third-party appraisals or valuations on our assets by groups like Cushman Wakefield and CBRE and JLL, some of the biggest national firms in the country. And then also something, I guess I shouldn't say this because then I'm going to have people asking for it right away, but hopefully within the week, we'll have an operational audit that was just complete on us as well by a third-party firm. Actually, it was ordered by a bank who's providing us a leverage. So they just completed a very in-depth operational audit on our lending business that I'm told will be complete by end of this week. So as soon as we get that operational audit, we'll be providing that out to investors as well, which gets into really a lot of the deep weeds of how we actually operate internally and how we underwrite risk and how we actually go through the process of following our risk mitigation policies and so forth. So really excited about that.
Excellent. So as we're running out and winding out of time here, Melanie, just one last question for you, perhaps. Just again, as you're thinking about DLP and the investments, any last words you want to leave our investors with?
I would say that we take and we do the worrying for you. So we really focus on running our communities well, whether it's single family, multifamily, commercial. And we do that for you as well as for our residents and for our team members.
Excellent. Well said. Thank you very much, Don. Thank you. As always, we appreciate everyone joining us. We'll be back again live next week. We want to wish everyone a safe and blessed Memorial Day weekend. Thank you.
Awesome. Thanks, everybody.